Welcome to the deep dive, your shortcut to being truly well informed. Today, we're jumping right into the latest financial story from Titan Company Ltd. This is just about following over numbers. It's really about getting the strategic pulse of a huge player in lifestyle retail. We've gone through their Q1 FY26 earnings call. That's April to June this fiscal year, plus their press releases, the financials. Our mission to pull out the key insights, give you some surprising facts, and help you quickly understand what's really powering this Titan of industry. Okay, so right off the bat, the headlines look well, undeniably strong.
Titans put up a really remarkable Q1 FY26. Consolidated revenue up 21% to almost 15,000 crores. That's 14,966 crores. But here's what really
Indeed. And those numbers, they aren't just impressive on their own. They really demonstrate the core strength and, frankly, the adaptability of Titan's diversified model. The MD himself said it was a very satisfying quarter across businesses, markets, and subsidiaries, and you can really see why when you dig into how the different parts performed. So yeah, this dive should uncover exactly how they pulled it off. From resilient jewelry performance, even with the gold prices up there, to an exceptionally strong quarter for watches. It really shows their different strategic levers working.
That sets the stage perfectly. So let's start with the core, the heart of Titan's business, the jewelry segment. It posted solid growth, 19% revenue increase.
Especially getting into the black internationally. Well, the key dynamic was really how they navigated customer behavior. Elevated gold prices, yes, they did push some customers more towards plain gold, coins, maybe less studded jewelry. But Titan didn't just sit back. They actively worked on boosting the average ticket size, especially in the studded category. And that largely offset the gold price impact on footfall. Plus, you mentioned Carat Lane, their subsidiary. They ran a really smart gold coin promotion. It wasn't just about selling metal. It turned out to be a pretty effective way to bring new customers
into their whole ecosystem.
Right, so strategic adaptation. Okay, that leads to the big question, market share. It's a crowded space, right? You've got, 7, 8 big national chains, maybe 8, 10.
Yeah, management sounds very confident on this. They base it on triangulating data. So looking at the overall market trends, their own internal tracking, and even data from the World Gold Council. Their belief is they definitely gained share last fiscal year, FY25, and they sustained that national lead in Q1 FY26. Now, you might see their same-store growth figures and think they look maybe a bit slower than some new players, but those new players are often starting from a tiny base, right? Titan scale is massive. Their analysis suggests it's more often the
Regional players losing share. And, the geography mix matters too. Gold versus studded preferences vary region by region.
Interesting. That's a strong position. It does.
They're very clear on this. They're absolutely not holding back on growth to protect margins. It's quite the opposite. They're pushing hard, staying competitive on gold rates, introducing products with lower making charges, less complex designs, think gold-heavy studded pieces to hit wider price points, and crucially, tech investing big time. Retail expansion, store makeovers, marketing spend. Now, their Q1 EBIT margin for jewelry, that's earnings before interest and taxes, was 11.0%. But, and this is important
For you to understand, about 50 crores of that was a one-off gain from hedging. That's expected to reverse in Q2 or Q3. So their underlying guidance for jewelry margins is still that more, let's say,
exactly. It was a direct response, really, to those climbing gold prices. Gold rates had basically pushed them out of some key price brackets, especially that sort of 30,000 to 40,000 rupee range. Super important for gifting. So the 9-carat diamond pieces are designed to get back into that accessible zone. They started in online only, but the traction has been steady. Apparently no customer pushback, even before official hallmarking was sorted. So now they're rolling it out to all 300 stores.
where it's more about fashion, adornment, less about pure investment value. And interestingly, they don't think it needs its own separate brand. It'll stay under Carrot Lane and MIA, maybe with an even stronger on.
Well, this picture is, 11% for Tanishq Cook. Might be lower than they'd ideally like. But the overall Indian studded market is huge, estimated around 75,000 crores. And it is growing. India is the world's second biggest diamond market, remember. What they're seeing is what they call dichotomous behavior, kind of split trends. So last year, solitaires, especially the bigger ones over at Carrot, they kind of underperformed. There was media noise about price uncertainty. But that seems to have stabilized now. At the same time, you've got this strong flow of new customers coming in at lower
price points. That's driven by India's demographics, young working women looking for everyday pieces. But interestingly, the high-end pieces over 5 lakh rupees in Tanishq and Zoya, that's also...
But they do acknowledge challenges. Broader consumption constraints are real. Competition is intense. Everyone wants a piece of the higher margin diamond action. And it's competing for discretionary spend, right? Someone might choose a fancy holiday over a necklace.
That's a really detailed picture of a complex market. Okay, this leads us straight into the big debate. Lab-grown diamonds, LGDs, where does Titan stand on these right now?
Titan's view, clearly stated, is that the talk around LGDs is currently far larger than the reality. The estimated LGDs are less than 2% of the total diamond market today. What's really striking is how fast LGD prices are dropping. Wholesale prices are falling even quicker than retail. Now around, 30,000 to 50,000 rupees per carat
in India? They see low barriers to entry, not much differentiation between producers. That could easily lead to it becoming a commodity. And fascinatingly, the early buyers of LGDs
But pragmatic approach makes sense for a legacy brand. Okay, let's move on from diamonds. Let's talk about another bright spot. The watches division. Sounds like they had an exceptional quarter, a fantastic 24% growth, hitting 1,273 crores, and the EBIT margin 22.6%. That's really healthy. What fueled that?
Yeah, watches really was exceptional, and it's not just one thing, it's the result of several long-term strategies paying off. It's their ongoing
push towards premiumization, moving up the value chain, but also the work they've done on the volume side for their big mass fashion brands like Sonata and Fast Track. Analog watches were the main engine, up 20%.
And maybe their broader store strategy. Are they just opening lots of new shops?
Well, they added 9 new watch stores net in Q1, but it's important to look beyond just that number. Titan's also very active in relocating or significantly expanding existing stores. They did 8 of those in Q1 alone for watches. So that strategy really boosts their total retail space and improves the shopping experience. It's something you might miss if you only count brand new openings. It's a smarter kind of expansion.
Right, optimizing the network. Okay, let's switch gears to the eye care segment. That saw 13% growth, reaching 238 crores. But this segment also saw some store closures. So what's the strategic play here? How are they reimagining this business?
Yeah, reimagining is their term. They're aiming to make the eyewear business more multi-purpose, multi-brand. So yes, 20 stores were closed net. These were mainly underperforming ones. But they also opened new ones, including their first international spot in Sharjah, UAE. The real focus seems to be on improving the shopper experience and just strengthening the overall value proposition. Interestingly, sunglasses did much better than prescription eyewear this quarter. Could be seasonal, could be a shift in how people are spending discretionary cash in that category.
one of the really interesting parts for me is their emerging businesses. That's Tanera, the Indian dresswear, fragrances, fashion accessories. Together, they grew a hefty 35% to...
Yeah, the growth there is pretty striking across the board. Women's bags, their brand Iris, surged 65%. That suggests good market acceptance, for the design and function. Fragrances, the skin and the fast-track perfumes grew 56%, mostly driven by volume, which is healthy. And Tanera, the ethnic wear brand, grew 15%. What's notable there is it was all from same-store performance. That points to them getting better penetration in existing stores, seeing early double-digit volume growth. It means the merchandising and customer
Connection is working well.
Very encouraging signs there. Finally, in the segment overview, let's touch on Titan Engineering and Automation Limited, TEAL. That division delivered really strong 56% growth.
TEAL is a really fascinating kind of multi-layered part of Titan. Its growth stems from three main areas. First, there's manufacturing services. This mostly serves aerospace clients outside India. They've successfully climbed the value chain, doing minor sub-assemblies now, securing long-term business from big names like Raytheon and Pratt. So that's a sustainable long-term growth engine. Second, automation solutions. Here they provide custom automation, assembly, testing solutions, both in India and globally. They've got a growing mix of clients, auto, consumer goods, medical.
Includes a lot of work related to electric vehicles, too. And the third bit is a dedicated product business. This leverages their automation skills for one specific, large global
That's a great breakdown of a complex division. Okay, so beyond this organic growth across the board, what about strategic moves, acquisitions? What has Titan been doing there recently?
Right, this really highlights their ambition to expand and diversify further. Two key deals recently. First, their subsidiary, Titan Holdings International, agreed to buy a 67% stake in Damas LLC, based in the UAE. That cost AED $1,038 million. Why is that significant? It massively boosts their presence in the whole
GCC region, the Gulf. Combine that with their U.S. operations, and international consume be around 6% of total company sales. That's a big step up. The second one was TEAL buying Just Tech Specialized Test.
Busy on multiple fronts then. So finally, let's look ahead. What's the management saying about the rest of FY26? Can they keep this momentum going, especially with those, consumption headwinds still out there?
Yeah, they've firmly stuck to that 11 to 11.5% core margin guidance for jewelry. They acknowledge Q1 was strong, but they're upfront that those one-off hedging benefits will unwind in the next couple of quarters. The top priority, still growth and market share. They're signaling quite clearly they won't hesitate to
Keep investing for the long term, even if it puts a bit of pressure on margins short term. The MD specifically mentioned the ongoing consumption challenges in the broader market. He stressed that
What an insightful deep dive into Titan's Q1. It's really clear they've had a powerful start to the year, driven by, growth across the board, core businesses, emerging ones, plus strategic buys boosting their global reach, and this real commitment to innovation, even when the market's a bit tough.
It really makes you think, doesn't it? How a company like Titan, with such a strong legacy, leading the market in traditional areas, how do they balance that need for aggressive growth and adapting to constant
change? Think about new materials, digital disruption, shifting ideas of luxury. How do they embrace all that without sort of diluting the value and trust built up in their core?